What if I told you there are two accounts that shape your retirement more than any stock pick? The real trick isn't picking one over the other, it's learning how to use both together. Today, we're breaking down Roth IRA versus 401k in plain language, and with a plan you can start this year. No hype, just concrete steps you can actually follow. First, what are these accounts in simple terms? A 401k is an employer-sponsored plan that lets you save money before taxes are taken out. A Roth IRA is an individual account you open yourself, with after-tax money that grows tax-free. The big difference comes down to taxes. With a traditional 401k, you get an upfront tax break and pay taxes later when you withdraw. With a Roth IRA, you pay taxes now, but withdrawals in retirement are tax-free. Contribution limits matter too. The 401k limit is higher and often rises with inflation. The Roth IRA limit is smaller, and it can be affected by your income. When you hear max out, that usually means different numbers for these accounts. Employer match changes the calculation in a big way. If your employer offers a match, that can be worth more than any investment idea. Getting that match is usually free money, so it should be part of your plan. Fees and investment choices matter as well. A 401k often has a limited menu chosen by the plan. An IRA gives you more options, but you're responsible for choosing wisely. Another important point, withdrawals. Traditional accounts force you to take money later in life through RMDs. Roth IRAs don't require minimum withdrawals for the original owner. That difference can matter for your taxes and your estate plan. Direct contributions to a Roth IRA have income limits. If you earn too much, you can't contribute directly. That's where some people use a backdoor approach, which is legal but needs care. If your plan offers a Roth 401k, you've got a new twist. It behaves like a traditional 401k for the tax you defer now, but the money you withdraw later can be tax-free like a Roth. You can mix traditional and Roth inside a 401k, which is a tax diversification move. So, who should care about Roth versus 401k? People at different stages of life, with different tax expectations and different employer benefits. The best path is not a single rule, but a flexible plan you can adjust over time. Here's a practical framework I use with clients to decide how to split between Roth and traditional accounts. It has 3 questions you can answer every year when you file or when your finances change. First question, what is your current tax rate and what do you expect in retirement? If you expect higher taxes later, Roth money can be very valuable. If you expect lower taxes later, traditional accounts might win on tax deferral. Second question, how strong is your employer match? If you're not getting the match, you're leaving money on the table. The safest move is to contribute enough to get the full match first every year. Third question, can you contribute directly to a Roth IRA given your income? If yes, max it out if you can. If not, consider the backdoor route, but plan for the taxes that come with converting. Now, let's turn those questions into a step-by-step plan you can use this year. Step 1. Secure the match. Contribute at least enough to your 401k to get the full employer match. This step is non-negotiable in most plans because it's an immediate 100% return on your money. Step 2. Decide about a Roth IRA. If your income allows, contribute to a Roth IRA up to the annual limit. Do this even if you're also contributing to a 401k because tax-free growth in retirement is powerful. Step 3. Evaluate a Roth option inside your 401k. If your plan offers Roth 401k contributions, consider putting some money there. The mix depends on your current and expected future tax rate and on how much flexibility you want in retirement. Step 4. Use a backdoor Roth if you're ineligible for a direct Roth IRA. You contribute to a traditional IRA, then convert to a Roth. Be mindful of the pro rata rule and any tax impact from other traditional IRAs you may own. Step 5. Balance the tax diversification. Some people choose a mix, traditional 401k, Roth 401k, and Roth IRA. The goal is to create a retirement tax picture where withdrawals don't all land on one bill. Step 6. Plan for withdrawals with intent. In retirement, you'll draw money from different sources. If you expect higher future taxes, you might prioritize Roth withdrawals or convert pre-tax money gradually to manage tax brackets. Step 7. Reassess annually. Tax laws change, your income changes, and your plans evolve. A yearly check-in helps you keep the strategy aligned with reality. Let's walk through a practical example to see how this can work in real life. Imagine you're early in your career, earning $70,000 a year. Your employer offers a 5% dollar-for-dollar match on a 401k. Your plan also includes a Roth 401k option, and you can contribute directly to a Roth IRA as well. Your first move is to contribute enough to get the full match. That's 5% of your salary, or about $3,500 a year. You don't want to pass up that free money. Next, you look at the Roth IRA. If you qualify, you add the maximum you can to the Roth IRA, which is around several $1,000s a year. The exact number can change with inflation, so check the current limit, but aim for the max you can comfortably afford. After funding the match and the Roth IRA, you still have room in your budget for the Roth 401k if you want more tax-free growth. You might split the remaining amount between the traditional 401k and the Roth 401k to balance tax today with tax-free growth later. In this early stage, the emphasis is on tax diversification and the employer match. The Roth money you contribute now can grow to a sizable tax-free chunk in retirement, especially if the market rises and you stay invested for decades. Now, fast forward a few years. You're in your mid-career with a higher income, perhaps $120,000 a year, and you're thinking about the tax hit of retirement withdrawals. You've already built a foundation, the 401k with a match, a Roth IRA, and some Roth 401k contributions. This is when you might shift a bit toward more Roth if you expect your taxes to rise in retirement. You still keep some traditional money to anchor your current tax bill, but your mix leans more toward tax-free growth. If your income is high and you can't contribute directly to a Roth IRA anymore, you can still use the backdoor Roth. The key is to plan the conversion at a time when you have other non-IRA money you won't mind paying some taxes on, so you're not surprised by a big tax bill. Another practical move: donate to a health savings account if you have a high-deductible plan. HSA money is triple tax-advantaged and can complement your retirement strategy by acting as a small, flexible, tax-free cushion in retirement. What about the costs? A 401k typically comes with management fees and fund-level fees. An IRA can give you cheaper options if you pick low-cost funds carefully. The difference can add up across decades, so it's worth watching. Here are a few common mistakes to avoid. Don't skip the employer match out of fear of taxes. Don't assume you'll be in the same tax bracket in retirement as today. Don't ignore the Roth option inside your 401k if you have one. A simple mental model can help you stay sane when decisions feel heavy. Think of two tax buckets, one that taxes you now, the pre-tax money, and one that taxes you later, the tax-free or tax-deferred money. Your job is to balance growth in both buckets so you're not surprised by a big tax bill at retirement. If you prefer a rule of thumb, here it is. Always cover the match. Consider a direct Roth if you qualify, and then decide how much to put into traditional versus Roth inside your 401k based on your tax forecast. Use the backdoor Roth only when you truly cannot contribute directly to a Roth IRA. What if your employer doesn't offer a match? Your plan should still aim for a steady growth path. You might lean more toward Roth now if you expect higher taxes later, or buckle down and contribute more to a traditional account if you expect lower taxes in retirement. Either way, you should still take advantage of the tax-free growth inside a Roth IRA whenever possible. As you grow older, your focus should shift slightly. You'll want to keep tax diversification in retirement. You'll plan withdrawals to minimize taxes and avoid big brackets unless you want to move income across years. The bottom line is simple. Roth IRAs and 401ks aren't rivals. They're two tools that work best when used together. The best path is a flexible plan that grows with you, not a single fixed rule you follow forever. If you found this helpful, I'd love to hear your approach in the comments. Have you maximized a match this year? Do you prefer Roth or traditional, and why? Your real-world examples can help others make better choices. If you enjoyed the video, please like it and subscribe to catch the next one. Share this with someone who's trying to figure out retirement, and drop a comment with a question you want covered next. Thank you for watching. I'll see you in the next video.